Today, we're going to pull back the curtain on one of the most, let's say, creative parts of corporate finance: pension accounting. Now, I know, it sounds super dry, but you've got to stick with me on this one, because this is where you find the secret to how some companies can take massive investment losses and somehow turn them into accounting profits.
I mean, think about that question for a second. It just doesn't make any sense, right? A company's pension fund gets absolutely hammered in a market crash, but the profit number they report on their income statement actually goes up. This isn't just some textbook theory. This is exactly what happened after the dot-com bubble burst. And if you're a serious analyst, you absolutely have to understand how this magic trick works.
All right, so here's how we're going to crack this case. First, we'll lay out the puzzle itself. Then we need to understand the two different kinds of pension promises a company can make, because that's where this all starts. From there, we'll get into the weeds and break down the actual accounting equation. Then we'll hit the core concept, this thing called the smoothing effect. We'll see how it plays out in the real world, and then we'll wrap up with the one question every single analyst needs to be asking.
Okay, so let's set the stage. Picture it. It's the early 2000s. The tech bubble has just spectacularly imploded. The markets are just bleeding out, and all these corporate pension funds, which were loaded up with stocks, are getting destroyed. You'd naturally think these companies would be reporting enormous pension costs, right? Well, what happened was the exact opposite.
And that right there is the puzzle we're here to solve. The actual economic value of their pension money was just vanishing, but the numbers they were putting on their official income statements got a big, surprising boost. It's a total disconnect between accounting and reality, and we're going to figure out why.
So, to really get this, we have to start with the basics. We have to know what kind of promise a company is actually making to its employees for their retirement. It really all boils down to two main flavors.
On one hand, you've got defined contribution plans. You probably have one. It's like a 401k. Your company puts some money in, but whatever happens in the market, good or bad, that's on you. The company's hands are clean. But then you have defined benefit plans. This is the old school company pension. Here, the company makes a solid promise. We will pay you X amount of dollars when you retire. That means the company is on the hook for all the risk. And because they're on the hook, the accounting gets really, really interesting.
So let's get into the mechanics of it. For a company with one of those defined benefit plans, how do they figure out the pension number that actually shows up on their official earnings report? Well, it all comes down to one key calculation. It's called the Net Periodic Pension Cost, or NPPC for short. And you have to burn this next part into your brain. This is an accounting figure. It's a number created by accounting rules. It is not the amount of cold hard cash the company actually paid into the pension fund that year. And that difference is, well, it's everything. So how do they build this NPPC number? You start with service cost. That's the value of the new pension promises your employees earned by working this year. Simple enough. Then you add something called interest cost, which is basically the interest growing on the pension debt you already have. But then, and this is the whole game right here, you get to subtract a number called the expected return on plan assets. Did you catch that word? Expected. This has nothing to do with what the fund actually earned. It's what the company assumed it was going to earn. And that little word, expected, brings us right to the heart of this entire thing. The accounting rules are written this way on purpose. They're designed to smooth out the crazy ups and downs of the stock market. They create this deliberate buffer between what really happens to investments and what a company reports as profit. The whole illusion hinges on this gap between the expected return and the actual return. You see, the company just picks a long-term expected rate, let's say 7 or 8%, and they use that nice stable number to calculate their pension cost. But in the real world, the actual fund might be down 20% one year and up 25% the next. The accounting rules are basically designed to let the company just ignore all that real-world chaos, at least in the short term. So how do they ignore it? Well, here's how. The difference between what they expected to earn and what they actually earned, those huge gains and losses, they don't have to report them all at once. Nope. Instead, the rules let them spread that impact out. They amortize it over many years. This is how the massive stock market gains from the late 90s were still being slowly dripped into the calculation as profits in 2001 and 2002, even though the market had already crashed and burned. And you can see this is exactly what companies do. Just look at these expected return assumptions. They're incredibly stable. They drift down slowly over a decade, from 8% down to 6.5%. But they don't bounce around every year like the real stock market does. It's that stability that creates the whole smoothing effect. So what happened when all this accounting magic, this smoothing, collided with the reality of a massive market crash?
Well, the story the accounting numbers told was very, very different from what was actually happening to the money.
And here it is. This is the punchline. For a huge chunk of the S&P 500, that pension number on their income statement literally went negative around the turn of the century. That means that, for accounting purposes, pensions weren't a cost at all. They were a source of pure income, juicing corporate profits at the exact same moment their actual pension funds were getting obliterated.
I mean, you can't say it any better than the San Francisco Fed did. The accounting rules acted like a shock absorber. They used the memory of old investment gains to paper over the new investment losses, and that directly propped up the earnings that companies were reporting to Wall Street. So, this all leads to a really crucial point. If you're an investor, if you're an analyst, you simply cannot take the reported pension number at face value. You have to peek behind the income statement curtain to see what's really going on with the health of that pension plan.
So here's your toolkit, and for anyone studying for the CFA exams, you have to know this. You've got to dive deep into the footnotes of the financial statements. First thing, find that expected rate of return assumption and ask yourself, is this actually realistic? Second, hunt for the unrecognized gains and losses. That's the key. It's like a hidden reservoir of past performance just waiting to flow into future earnings. And finally, compare the accounting expense to the actual cash the company put in. This all matters because this stuff can totally warp a company's PE ratio and make its earnings look way higher quality than they really are.
And that brings us to the one final question you have to ask yourself anytime you're looking at a company with one of these old-school pension plans. Is that expected return number they're using an honest, good faith forecast of what they think they'll earn in the long run, or is it just a lever they're pulling to manage their reported earnings from quarter to quarter? How you answer that question tells you an awful lot about the quality of that company's profits.
This is not financial advice.